Hello, today is 31st December 2020. I would like to take this opportunity to wish you a happy new year 2021. Today our topic is about capital budgeting technique. One of the most important decisions facing a financial manager is the choice of which investment the corporation should make. Companies need to invest in wealth-creating assets in order to renew, extend, or replace the means by which they carry on their business. Capital investment allows companies to continue to generate cash flows in the future or to maintain the profitability of existing business activities. It is important to select the best or most profitable investment projects so that the company can maximize the return to its shareholders. A good decision can help to avoid the negative strategic or financial consequences which could follow from poor investment decisions. I hope that at the end of this learning session, students will understand the key elements of the capital budgeting or investment appraisal process. There are 7 main investment appraisal methods covered in this video. These methods are commonly employed in business. I hope that students will be able to define, calculate, interpret, and evaluate the findings. We shall also discuss the underlying strengths and weaknesses of each approach. Having a good grasp of the capital budgeting techniques is important, and you can use them for investment appraisal. Stay tuned. Let's learn together. What is capital budgeting? Capital budgeting is the whole process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing owners' wealth. Companies make capital expenditures for many reasons. The basic motives for capital expenditures are to expand operation, to replace or renew fixed assets, or to obtain some other less tangible benefit over a long period. Brigham and Houston define capital budgeting as investment decisions involving fixed assets. Here, capital refers to long-term assets used in production, while a budget is a plan that outlines projected expenditures during some future period. Capital budgeting is the whole process of analyzing projects and deciding which ones to include in the capital budget. In this slide, I have listed down the 6 key capital budgeting techniques that we are going to learn. They are net present value, net terminal value, payback period, discounted payback method, average return on book value, as well as internal rate of return. We are going to learn them one by one. These methods are widely used in business. It is important to strengthen your foundation knowledge in these methods so that you can apply them in analyzing more complex investment decisions. What is NPV? How do we define NPV? In general, NPV is an investment appraisal technique that tells us how much a project contributes to shareholders' wealth. Kidman and Judah define NPV as a sophisticated capital budgeting technique found by subtracting a project's initial investment from the present value of its cash inflows, discounted at a rate equal to the firm's cost of capital. The NPV analysis uses discounted cash flows to evaluate capital investment projects. Berg and DiMarzio define NPV as the total of the present values of all projected cash flows. NPV is the difference between the present value of all benefits and the present value of all costs. If we use positive cash flows to represent benefits and negative cash flows to represent costs, take note that the larger the NPV, the more value a project adds value. How to calculate NPV? The NPV is found by subtracting a project's initial investment CF0 from the present value of its cash inflows CFT, discounted at a rate equal to the firm's cost of capital R. We can also find the NPV as follows. First, the present value of each cash flow is calculated, discounted at the project's risk-adjusted cost of capital. Second, the sum of the discounted cash flow is defined as the project's NPV. In the following formula, the CFT is the expected net cash flow at time t. R is the project's risk-adjusted cost of capital or weighted average cost of capital, and N is its life. Take note that when NPV is calculated, both inflows and outflows are measured in terms of present dollars. The discount rate used reflects the opportunity cost of the funds. If the NPV is greater than zero, this means the rate of return is higher than the cost of capital. Therefore, we shall accept the project. If the NPV is less than zero, this means the rate of return is less than the cost of capital. Therefore, we shall reject the project. If the investment projects are mutually exclusive, select the one that has the higher NPV, as it will add more value. Let's look into an example on how to calculate net present value. A project requires an initial outlay of 120,000. There are two questions here. Try and answer the two questions. I'm going to show you the working here. As this project involves time 0 and time 1, we shall use this set of formula here. C0 stands for initial investment today. C1 refers to the cash flow in 1 year period. R represents the discount rate. In question 1, the discount rate is 8%. We are going to discount the cash flows and find the present value. For example, in year 1, the present value is found by 135,000 divided by 1 plus 8% power of 1. Then we sum up all the present value together. As the NPV is positive, we shall accept the project. In question 2, the discount rate is higher at 13%. The NPV is lower. Instead, the NPV is negative. We shall reject the project. NTV stands for Net Terminal Value. NTV is a variant of NPV. Technically, NTV is the future value of NPV. Instead of moving all cash flows to the present, they are moved to the end of the project's life. Instead of discounting cash flow, they are compounded. The relationship between NPV and NTV can be expressed as NTV is equal to NPV multiplied with 1 plus R power of n, where n is the number of periods over which the cash flows run. R is the interest rate. The accept or reject criterion is the same. NTV will lead to exactly the same decision as NPV. The payback period is the amount of time required for the firm to recover its initial investment in a project, as calculated from cash inflows. It is found by counting the number of years it takes before the cumulative cash flow equals to the initial investment. The payback period is generally viewed as an unsophisticated capital budgeting technique because it does not explicitly consider the time value of money. How to calculate the payback period? We start with the project's cost, a negative value, and then add the cash inflow for each year until the cumulative cash flow turns positive. The payback year is the year prior to full recovery plus a fraction equal to the shortfall at the end of that year divided by the cash flow during the full recovery year. This formula is from the textbook of Brigham and Houston. When the payback period is used to make accept-reject decisions, the following decision criteria apply. If the payback period is less than the maximum acceptable payback period, accept the project. On the other hand, if the payback period is greater than the maximum acceptable payback period, reject the project. The maximum acceptable payback period is also known as cut-off period. The length of the cut-off period is determined by the management. The value is set subjectively on the basis of a number of factors, including the type of project, the perceived risk of the project, and the perceived relationship between the payback period and the share value. If the projects are mutually exclusive, the shorter the payback, the better the project. To conclude, the payback investment rule states that you should only accept a project if its cash flow payback is initial investment within a pre-specified period. Let's look into an example on the payback period. If we want to recover our outlay in 1 year, which of these projects do we undertake? I'm going to show you the calculation of the payback period. First, we calculate the cumulative cash flow for each project. For project A, the cumulative cash flow in year 0 is negative 2,000. The cumulative cash flow in year 1 is negative 2,000 plus 2,000 and is equal to 0. Therefore, the payback period of project A is 1 year, as the initial investment of 2,000 is fully recovered at the end of 1 year. For project B, the cumulative cash flow in year 0 is equal to negative 2,000. The cumulative cash flow in year 1 is equal to negative 2,000 plus 1,000 and is equal to negative 1,000. The cumulative cash flow in year 2 is equal to negative 1,000 plus 1,000 and is equal to 0. Therefore, the payback period for project B is 2 years. The initial investment of negative 2,000 is fully recovered by the end of year 2. Project C is slightly unique. The cumulative cash flow turns positive in year 3 or after year 2. There is an outstanding amount of 100 at the end of year 2. The cash flow to be generated in year 3 is 400. Therefore, the payback period for project C is 2 plus 100 divided by 400 and is equal to 2.25 years or 2 years 3 months. Here is the answer for the example. As the cutoff period is 1 year, based on the payback period, we shall accept project A but reject project B and C. The advantages of payback method are: it is simple, easy to apply. It is a straightforward measure that everyone can understand. There is no need to forecast cash flows over the whole of a project's life. Payback is sometimes used as a rough proxy for the riskiness of a project. The longer the investment period, the higher the uncertainty and risk. In addition, payback can be an efficient screening device to remove projects with very long lives. The payback method suffers from serious shortcomings that it should only really be regarded as a first screening method. First, this approach fails to take fully into account the time factor in the value of money. The payback rule gives equal weight to all cash flows before the cutoff dates. Cash inflows occur earlier should have higher net present value at any discount rates. All dollars received in different years are given the same weight. The time value of money is ignored. A second weakness of payback is its failure to recognize cash flows that occur after the payback period. Cash flows beyond the payback year are given no consideration, regardless of how large they might be. Third, if we use the same cutoff regardless of project life, we will tend to accept many poor short-lived projects and reject many good long-lived ones. There is no necessary relationship between a given payback and investor wealth maximization. It also ignores the project's cost of capital. Fourth, the method could be complicated by an outflow after period 0. Lastly, the appropriate payback period is merely a subjectively determined number. It cannot be specified in light of the wealth maximization goal. The cutoff period relies on an ad hoc decision criterion. It is uncertain what is the right number of years to require for the payback period. The payback method can be modified by discounting the project cash flows by the company's cost of capital in order to take account of the time value of money. The discounted payback period can be defined as the length of time until the sum of the discounted cash flows is equal to the initial investment. The discounted payback measure asks, how many years does the project have to last in order for it to make sense in terms of net present value? Based on the discounted payback rule, an investment is acceptable if its discounted payback is less than some pre-specified number of years. Take note that a discounted payback rule will never accept a negative NPV project. On the other hand, it still takes no account of cash flows after the cutoff date. Now we are going to use the same example to calculate the discounted payback period. There are three projects here. The projects are the same: Project A, Project B, and Project C. I'm going to explain the calculation here. In this example, the discount rate is 10%. I'm going to use the present value formula to calculate the discounted cash flow. For Project A, the discounted cash flow for year 0 is negative 2,000 divided by 1 plus discount rate power of 0, and the value is negative 2,000. For year 1, the discounted cash flow is 2,000 divided by 1 plus 10% power of 1. The cumulative cash flow for year 0 is negative 2,000. The cumulative cash flow for year 1 is negative 2,000 plus 1818.18, and the value is negative 181.82. Project A does not manage to recover the original capital investment, as the cumulative cash flow is still negative at the end of the project. For Project B, the cash flow turned positive at year 3. This means that the discounted payback period is 2 plus 264.46 divided by 3756.57, and the discounted payback period for Project B is 2.07 years. For Project C, the cumulative cash flow at the end of year 3 is still negative. Project C also does not manage to recover its initial investment. We can also calculate the net present value of each project by adding up the discounted cash flow. To conclude, only Project B has a positive net present value. Project B break even after 2.07 years. However, Project B cannot fulfill the maximum acceptable cut-off period of 1 year. Here is the final answer. I hope you will try on your own. The advantages of the discounted payback period are as follows. It includes time value of money. It is easy to understand. It does not accept negative NPV investment. And lastly, it provides information about liquidity and risk. The shorter the payback, other things held constant, the greater the project's liquidity. The discounted payback period has a couple of significant drawbacks. The biggest one is that the cutoff has to be arbitrarily set, and cash flow beyond the cutoff date are ignored. As a result, a project with a positive NPV may be rejected because the cutoff is too short. In addition, just because one project has a shorter discounted payback than another does not mean it has a larger NPV. The discounted payback rule is biased against long-term projects. The average return on book value is also known as return on capital employed. There are two ways of expressing it. First, we can divide the average annual income of a project by the average annual value of an investment. Second, we can divide the average annual income of a project with initial outlay. For a project to be acceptable, it must meet or exceed the specified hurdle rate. The advantages of the average return on book value are as follows. It is easy to use. It can be used to evaluate projects in terms of accounting profitability. This method is logical from accounting point of view. There are a few disadvantages. This method uses accounting profits instead of cash flows. There is no discounting involved. Equal weights are assigned even to distant cash flows. Hence, this method ignores the opportunity cost of capital. As a result, additional yardstick is needed to compare between two projects. The internal rate of return (IRR) is a very popular method of project appraisal. Like NPV, it takes into account the time value of money. The IRR tells you the rate of return you will receive by putting your money into a project. IRR is the discount rate at which investment has zero net present value. It is the discount rate that equates the NPV of an investment opportunity with zero, because the present value of cash inflows equals the initial investment. IRR is also referred to as the yield of a project. Mathematically, the internal rate of return is the discount rate that causes NPV to equal zero. So, to find the internal rate of return for an investment lasting T years, we must solve for the IRR in the following equation. There are two popular ways to compute the internal rate of return. First, the internal rate of return can be calculated with a computer spreadsheet. For example, the IRR function in Microsoft Excel. Second, the IRR can be calculated based on trial and error method, which means we shall try until we get the correct IRR. If the NPV is positive and large, we shall increase the discount rate. When the discount rate increases, NPV will be reduced. If the NPV is negative, we shall decrease the discount rate until NPV is equal to zero. When the internal rate of return is used to make accept-reject decisions, the decision criteria are as follows. If the internal rate of return is greater than the cost of capital, accept the project. If the internal rate of return is less than the cost of capital, reject the project. These criteria guarantee that the firm will earn at least its required return. Such an outcome should increase the market value of the firm and therefore the wealth of its owners. Here is an example on how to solve for the internal rate of return. The discounted cash flow is calculated by using the present value formula. You may start with any discount rate, for example 5%, in which case you will obtain a high positive NPV. So you have to keep increasing the discount rate until NPV is equal to zero. If you use 0.6815 as the discount rate, the NPV is close to zero. If you use a higher discount rate, for example 0.7, you will get a negative NPV. Many financial managers like internal rate of return because it gives an investment performance measure in terms of a percentage rate of return. There are problems and pitfalls associated with the application of IRR. I hope you can read based on the 5 key topics highlighted in this slide. Some of these problems can be overcome by modifying the analysis. The detailed discussion is too lengthy to be included in this video. If time allows, I will create another video on this topic. Meanwhile, your textbook is a good reading material to learn about the problems of IRR. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.